Imagine a concert where thousands of people rush through the gates the moment they open. Everyone is pushing forward, trying to get the best seats before anyone else. The atmosphere is electric, the crowd is cheering, and from the outside it looks like a massive success. But hidden behind another gate is an even larger crowd waiting for their turn, and in exactly 90 days that second gate will open too. This simple image helps explain one of the biggest risks investors often overlook after a major IPO. If SpaceX has recently gone public, the biggest risk may not be today. In fact, it may arrive 90 days later. While millions of investors focus on the excitement of buying shares, very few pay attention to what happens when the people who already own large amounts of stock are finally allowed to sell. Today we're going to uncover one of the most misunderstood events in investing and explain why some of the smartest investors on Wall Street pay more attention to day 90 than they do today. When a company goes public, it feels like a celebration. News channels cover it nonstop. Social media lights up with excitement, and investors begin imagining life-changing returns. Almost everyone starts asking the same question: should I buy before it's too late? This is where a powerful psychological force takes over. It's called FOMO, or fear of missing out. Nobody wants to be the person who ignored the next great opportunity. Nobody wants to hear a friend say they bought early and doubled their money while they sat on the sidelines. As a result, people rush in. However, there is something many investors don't realize. The people buying shares on IPO day are often not the only people who own the company. Long before the public had a chance to buy stock, there were founders, early employees, venture capital firms, and private investors. These groups often own enormous amounts of stock, sometimes far more than the shares initially available to the public. Now imagine you've worked at SpaceX for 10 years. Part of your compensation came in company shares, and over time those shares have increased dramatically in value. Suddenly the company goes public, and on paper you're worth millions of dollars. There's just one problem. You usually can't sell your shares immediately. This is where something called a lockup period comes into play. Although the name sounds complicated, the concept is actually very simple. Think of it as a temporary freeze. The insiders who already own stock agree not to sell for a specific period after the IPO, often around 90 to 180 days. The purpose is to prevent everyone from selling at once. If millions of shares suddenly flooded the market on day one, the stock price could come under serious pressure. So the shares remain locked for a period of time. But eventually that lock expires, and that's when things become interesting. To understand why, imagine a town with only 100 houses available for sale. Because supply is limited, prices start rising as more people compete to buy. Now imagine that overnight another 1,000 houses suddenly become available. The houses themselves haven't become worse, but the increase in supply changes the market. Prices often come under pressure simply because buyers have more options. The same thing can happen with stocks. When a lockup period expires, a huge number of additional shares can become available for sale. This doesn't automatically mean the company is in trouble. In fact, many insiders sell for perfectly reasonable reasons. They may want to buy a home, diversify their investments, or reduce the risk of having most of their wealth tied to a single stock. These are often smart financial decisions. The problem is that markets don't always react rationally. When investors see insiders selling, many immediately start asking questions. What do they know that I don't? Fear begins spreading through the market, and sometimes that fear becomes more powerful than the actual selling itself. This is where psychology takes over. The stock market isn't just a collection of numbers, it's a reflection of human behavior. People get excited together, panic together, and often follow the crowd. When prices rise, investors feel confident. When prices fall, they become nervous. That's why lockup expirations can create volatility, not necessarily because something changed inside the company, but because something changed inside investors' minds. History has shown that some IPOs barely react when their lockup periods end, while others experience significant declines. The point isn't that every stock falls after day 90. The point is that risk often appears when people stop paying attention. Think about driving a car. Most accidents don't happen because people are alert and focused. They happen when people become comfortable and let their guard down. Investing can work the same way. The IPO headlines fade, the excitement settles, and investors assume the risky part is over. But sometimes that's exactly when the next challenge begins. Now let's talk specifically about SpaceX. Investors are excited because SpaceX isn't an ordinary company. It revolutionized the space industry, pioneered reusable rockets, and became one of the most valuable private companies in the world. Many people believe it could shape the future for decades to come, and that belief may be completely justified. However, there's an important investing lesson here. A great company and a great investment are not always the same thing. A company can have amazing products, a brilliant future, and extraordinary leadership, yet still become overvalued if investors become too excited. Imagine paying $10 for a bottle of water. The water didn't become bad. You simply paid too much for it. Investing works the same way. The real question isn't whether SpaceX is a great business. The real question is what price investors are willing to pay, and whether expectations have become unrealistic. This is where many beginners make mistakes. They fall in love with the story, stop analyzing the risks, and assume success is guaranteed. Successful investors think differently. Instead of asking how rich they can get, they ask what could go wrong. Professional investors spend enormous amounts of time thinking about risks, not because they're pessimistic, but because risk management keeps them in the game. The 90-day lockup expiration is one of those risks worth understanding. Will SpaceX crash after day 90? Nobody knows. Anyone claiming certainty is simply guessing. The stock could continue rising, remain stable, or experience increased volatility. What investors do know is that a major event is approaching, and major events deserve attention. Smart investors don't react emotionally. They prepare. They think about possibilities before they become realities. They focus on probabilities instead of predictions. That mindset is often what separates successful investors from gamblers. At the end of the day, investing isn't about being right every single time. It's about avoiding costly mistakes, understanding human psychology, and recognizing when excitement may be clouding your judgment. The next time you hear people celebrating a massive IPO, remember this. The first day is usually the most exciting, but it isn't always the most important. Sometimes the real story begins weeks later. Sometimes the biggest risk appears after the headlines disappear. And sometimes day 90 tells you far more than day 1 ever could. The crowd will always focus on the fireworks, but smart investors pay attention to what happens after the smoke clears, and that may be the most valuable investing lesson of all.